Good morning, good afternoon, good evening, everybody. Welcome to our most recent episode of Note Nation Top 40 Tour as our virtual bus rolls into the windy city of Chicago as we discuss the different opportunities, the current market stats, what's going on in this crazy market, and the state of Illinois, along with featuring, kind of what are the opportunities, where are the long-term, short-term ideas for real estate investors out there, because there's a bunch of them. You just got to know where to look and where to spend your time on and what not to spend your time on half the time. But honored to have you all. If you're watching this live, hey, in the chat roll, type in where you're from. If you're watching this live on Facebook or on the recordings, please feel free to type in where you're from. I do look at the comments. I do comment and connect with those that are watching this either live or as a replay. So thank you again for joining us here on the Note Nation Tour. Like I said, honored to have you guys. We've got a very busy schedule. This is city number 4 on the tour. We've got Phoenix after this tonight as well, too. So I promise we'll get you out of here in just under an hour so you can get back with your evening and grab some dinner. So once again, welcome to the Note Nation Tour, guys. We do, and we are expecting to have, obviously, local and national investors watching this. People that are already doing deals. People are looking to get started in new things. We're going to be discussing some of the statistics and the numbers that we've been researching and looking at for Chicago and Illinois and stuff like that. So we'll talk about that. We'll talk also about the second half of 2020 outlook, what it means, where you should be looking at, where you should be spending your time, what you should wait a while on, and when you should start diving into. So we'll even discuss where and when to kind of get started with you guys here. So anyway, who is Scott Carson? I am a active real estate investor since 2002. Been in the finance, debt, and mortgage market since 2004. Purchased over $500 million in debt. I am the CEO of WeCloseNotes.com, and I've been excitedly teaching and happily teaching other real estate investors how to dive into the distressed market, distressed real estate space for over a decade now. And really, that's what I get the most joy out of, is really helping people take their business to the next level. I also really love working with borrowers and investors out there and people in trouble that need a helping hand. So I also have a very popular podcast called The Note Closer Show. Hopefully you're listening to that. If you don't, check it out on anywhere that you get your podcast, or at our website or on YouTube as well. But I've been investing all across the country for 10 years, over 10 years now, even though Austin, Texas is home. And yes, I have bought stuff in Chicago. I have had some good deals. I've had some damn dumb, horrible deals take place. So I've got a love-hate relationship with the city. I love Chicago sports team, avid Bulls, definitely Blackhawks. I'm a big Cubs fan. Do respect the White Sox as well. We go on, go the Bears as well. But one of the things that is interesting is Chicago's just a weird market, and I feel it's honestly that love-hate, I think, is a lot with the local people that live there. A lot of the local investors have a love-hate relationship with their county as well, and Cook and DuPage, and we'll get into a little bit of that later on. So, but anyway, let's dive into the numbers and where things are looking at right now for you guys. So what do the national numbers say? Obviously, we hear numbers coming out, doom and gloom. We were at an 11.1 unemployment rate as of last year. Basically, 1 out of 9 people are unemployed. That's 17.8 million people unemployed. Why is that number big? Is it reducing a little bit? Yeah, they're giving a positive spin on that. It went down a little bit this month, which is okay. They're also expecting 52% of small businesses are expected to fail. And this thing keeps going on for another 6 months. It's going to be even greater than that. 67% of small businesses expect to fail. And the small business owners, the mom and pops, those are the individuals, those are the people out there getting hurt the most, not the bigger brands, the biggest companies, these big hedge funds. We're talking about mom and pop investors like you and me on the call tonight are really being hurt the most. 10% of homeowners were already struggling to stay current before all this hit. If you didn't know that, yes, 1 out of 10 Americans were already roughly about 30 days behind on their mortgage. Not a good thing, and we'll talk about how that number is going to get worse. Nationally speaking, we're at a 7.76% national mortgage delinquency rate. That's across FHA, Fannie Mae, on average across the board. That number is going to get a whole lot worse for a couple of reasons, and I'll share that later on. Currently, we see 4.1 million Americans currently in default. Yes, A quarter of those unemployed are in default. Do we think that number is going to get higher than 4.1? Yes, we do. Obviously, states and governments have tried to put a freeze on that with moratoriums and evictions and foreclosure freezes. And we've seen that across the different markets. We're seeing that in Chicago right now. And it's going to get a whole lot worse before it gets a whole lot better. In comparison, let me give you some numbers about this. Back into the Great Recession, it took us 18 months when everything started to happen before we had 1.6 million people in default. Okay, 18 months before we had 1.6. Now, does anybody here think we're going to exceed that number a lot faster? Well, we already have, you know what I mean? We're not even 6 months into this thing and we're at 4.1. So it should tell you, you add in the unemployment rates, the small businesses closing, it's going to be a really bad storm. It's going to be worse than any ice storm hitting Michigan Avenue, I'll tell you that, okay? Yes, we know mortgage loan delinquencies hit a record spike over the past 2 years. And now how the numbers break down a little bit to that is if you read behind the numbers. And I'm a guy that likes to say, okay, give me the numbers and then I'll read behind them and see and come up with my own decision. Now, I've been talking about how we've had subprime or non-prime mortgages for quite a few years now, and this number should scare you a little bit. Non-prime loans experienced the greatest annual increase in delinquencies in June, rising 21.8%. Expanded prime loans charted the second highest increase. That's scary at 12.2% rise. Reperforming loans experienced a 6.4% annual incline, while prime loan delinquencies rose 5.5%. It's all across the board, everybody. Everybody is struggling. When you have companies laying people off and furloughs and all this stuff, it's not, 87% of Americans weren't prepared for something like this to happen. We all know that. Most people, they miss a paycheck and they have a $500 bill on a medical bill or something like emergency. They don't have the money to handle that. Now, if you look at the unemployment rates roughly in Chicago, I pulled this from the Labor Board statistics for you guys up there. And Chicago's really high. It's high. We talk about the national employment rate being 11.1. In the Chicago area, it's at 15.4. In April, it was 17.5. Don't have the most recent statistics yet for June or July, but I don't think it's gonna stay up there. I think it's gonna stay double digits and be higher than the rest of the country. You can go through and see all the different jobs that have high stuff. Non-farm, obviously 12%. Construction's down quite a bit. Manufacturing, what else is a high thing here? So other services down here, down 17.9%. It's a scary time. Lots of people unemployed, okay? And we look into the foreclosure numbers and where you start seeing stuff popping up. Here's where you look at stuff. And this was pulled off a realty track. 1 in every 7,500 homes is basically going to foreclosure in Chicago area, Cook County primarily. And you can see a lot on the south side is in foreclosure. That's not a real big surprise. Obviously, south side's pretty rough. If you pull up the Chicago gang map that the police department of Chicago puts on there every year, and talks about all the different gangs, but basically in the dark blue, you have 1 out of every 867 housing units, homes, basically going to the foreclosure. So it is definitely a divide between the haves and the have-nots out there. And you can see the 60603, the 60633 are some of the hardest hit counties out there for the most part. 6034. All right. You got a little bit across the board there. Then we look at the number of foreclosure distributions, how it was right before. This was May. So prior month is down 56%, over years down 92%, because they suspended the foreclosures for the most part. Dropped down. They stopped them. And you can see how it just fell off the cliff here in March. They're like, okay, we're going to stop these for the most part. That's not a real big surprise. Okay. Not a real big surprise with that. And then also you can see the number of activity there too for you. That's, it's dropped down. Now, I think we all will agree that when they finally get around to figuring out what the heck they're going to do, government-wise, city-wise, whatever, we know that number is going to skyrocket. It's a scary time. Let's talk about some of the bad news. 1 out of 11 borrowers in default. We talked about that already. 1.5 million Illinois people out of work. All right. 1.5 million people in Illinois out of work. That's higher than the national average. It was one of the highest rates of default. Illinois is expected to see a double foreclosures of what's going on They're defaulted up to 130,000 foreclosures. Now, they could break it down on a city by city, but that still means, depending on where the foreclosures take place, we know they're going to take place in Illinois, and you need to be kind of watching this depending on where you're looking at. Now, obviously, Illinois has a long foreclosure time frame, 630 days. Well, we know it takes longer than that. I've had to foreclose in some residential, some commercial properties. It is just a mess to foreclose, specifically in Chicago. In Cook County, it takes freaking forever to foreclose, okay? And then when you add in that you've got 6 months or another 12 months of forbearance agreements before you can start the foreclosure, start the eviction process, it's going to be a mess in Cook County. Now, other counties around Cook County, hey, you got some opportunity, but it's going to be, we've been saying this for a while, it's going to be at least probably 12 to 18 months before the REOs hit the market. Now, what's an REO for those that are new? That's a real estate owned. It's where the bank has foreclosed and taken the property back. Now, I know there's all sorts of realtors out there that, I'm going to get my license and I'm going to be the next REO agent here. Well, you better wait. You better be looking at something else, because you're waiting for 12 months to 18 months or longer to start looking at stuff. You're going to go broke and be one of those people facing foreclosure. You don't want that. So, and I got to thank Tom Vasicki. He emailed me when he saw I was when I was doing this. So thank you, Tom. I think you're live on here with us tonight right now. Shared us some of the insight what's going on there in the greater Chicago area. The mayor of Chicago wants a moratorium on rental and mortgage evictions and foreclosures. Largest foreclosure agent in the area predicting a 12 to 18 months before foreclosures hit due to the court systems and the governor legislature. Yep, nope, no surprise there. Kind of corrupt a little bit. I know you always run into the fact like, okay, here's my opinion of Chicago. If you live in Chicago and you're an investor in Chicago and you're a voter in Chicago, things go a lot faster for you than if you're an out-of-state investor. I only have experienced this multiple times. And here's a scary thing. I got to thank Tom again for saying only 18% of those that live in Illinois have more than 20% equity in their home. And if the market starts to drop in values, you're going to see a lot of people upside down again. Coming close to what it was in the Great Recession in 2008. There was an average of 185 evictions per day prior to COVID. Now they're expecting 3 to possibly 4 times that after that. They predicted to 4 years for rental evictions. That's in Cook County. That is crazy. I would not want to be a landlord in Chicago, Chirac, Cook County. Okay, yes, Chicago and Cook County is a mess. DePage is the best for getting things done through the judicial process. I would agree to that. Lake County is also pretty good. And this is a thing that you're going to see too. You're going to probably see this happening in other states out there as well. There's been a lawsuit filed against the governor on behalf of investors because they've taken away the ability for investors to get the rent. Not just to get the rent, but also to put food on the table. All right? It's a scary time for everybody. You know what I mean? And unfortunately, if you can't collect on your rent, you can't pay your mortgage. We all know there's some rough times in Chicago. Gotta be careful on the South Side. I've been there, all right? Had some stuff down there. Not a fun. So that leads to a big problem if you're an investor there in Chicago, especially on the residential side of things, all right? We talked about this, expecting a double, delinquency rate could double this year in a dramatic thing, and dramatic, doubling to nearly 9% or more, all right? Okay. You have Kane, Henry, DePage, Sangamon, and St. Clair counties all provide extensions without penalties on property tax due dates, okay? That's a scary thing. You look at what they're kind of predicting here. The baseline delinquent mortgages, all right, in the red there, kind of baseline, and then the numbers on the delinquent mortgages. That's just for Illinois, okay? Eek. Yeah, you're going to have a lot there. Of course, they predicted across the country we'd see about a 5% continued growth for the most part. Illinois is always kind of dragged behind it. It was like one of the slowest markets when it came to appreciation over the last couple of years. You've got a big chunk of Illinois' rental market. And so you got to keep in mind with that too. So let's talk about some of the foreclosures of the pandemic. Here, where you see the different type of loan programs being offered and their current default rates across the board. In the top there, FHA loans at 9.7 roughly. FHA, why is it so high? Well, a lot of the FHA loans, and we're seeing this, as I was talking to lenders and mortgage companies, FHA usually to bring some skin in the game, like 2-3% down, right? 3.5% down in some cases. Well, a lot of banks got so greedy that they would pay that down payment along with advancing up to 10 grand towards closing costs. That's 100% financing to somebody who probably doesn't have a decent credit. It's a mess, right? That's why it's such a high default rate. And you look at VA loans in the dark purple there, the conventional loans in the light gray. The conventional loans normally take 30-year fixed. You got to have some decent credit. That's why it's a lower default rate, but that's still ticking up too. As we talked in the first couple slides, everything's ticking up. I believe FHA will be over 12% before we're said and done. I believe you're going to see the others escalate beyond 5-6% in the next 60 to 90 days. It's going to be a mess. All right. It's going to be a mess. And you know what's going to happen? Besides jobs being gone and businesses closing the doors, there's going to be a lot of people looking at short sales, trying to drag out. And when you look at with us all being kind of consolidated, the side hustles have gone away that many people have been relying on to do some good, to put some money in their pocket. The Airbnbs, the Ubers, well, those aren't there anymore. Okay? Those aren't there anymore, and that hurts people as well. People are like, what the heck am I doing? Got to start collecting cans. You're going to see people families starting to connect together. Well, they're already connected, but you get what I'm saying, moving in. Single-family homes being multifamily homes, all right? It's going to be a bad thing. I mean, forbearance numbers, they talk about those retreating. This came out in June. Last month, I dropped down a little bit, down 0.1% from the previous week. But we're going to see more of those. We're at over 5 million forbearance agreements, and it's staying kind of flat there. And this continues to go on. When you start looking at big companies laying off, Delta laid off 36,000 employees the other day. People that have been on forbearance agreements now getting permanently laid off. Here's the thing too. I don't think we're going to have any major league sports this year. Baseball, I don't think is going to make it. The NFL, sure as heck no. I don't think we're going to have any college football. When you look at the Ivy leagues already starting to push things back out to next year, the spring, that leaves a lot of people too. In Chicago, obviously being a big sporting town, conventions aren't going to happen. You're going to have an increase in problems take place across there. So let's talk a little about some of that commercial debt and the commercial nightmare that's taking place right now. Can you hear it? That's the toilet flushing on the commercial markets, okay? We know it's getting ugly out there. We know tenants are wanting to pay. 52% of small business expected to fail. There's a whole lot of things. We've all been talking about commercial real estate. I've been saying this for 2 years now, that it can't keep going up, and we've seen that drop now. All right. Obviously, we're going to see a lot of rent. Commercial rents will get a lot cheaper. There's going to be a lot of vacancy. Let's talk about that. One out of every 5 hotel loans is in default. And with there being a lot of major hotels in Chicago, you could basically just look at them and say, okay, that's probably in default. That's default. When Hilton is at like 35-40% across the world. 1 in 10 retail loans across the country in default. Office vacancy is set to increase to at least roughly about 20% by the end of the year. And then that number is supposed to go up to 24-25% rolling into next year. We're expecting a 15% or greater vacancy rate for retail and restaurant space. Restaurants have been hit hard. We all know that. Fortunately, a lot of tenants, are being able to negotiate things with the landlords, because who else are they going to put in there? Let's try to keep something going with existing tenant, because if I got to kick them out and try to find somebody else, it may be a long day and a long night before I get somebody in there. We're expected to see rents drop another 10 to 10.5 to 11% by the end of the year and increase downward by 2021. Why is that important? Well, if you're looking at commercial space, you have to keep that in mind that I'm probably only going to see probably around 70% of rents compared to what they were in 2019. That's really what your market rent should be. All right. And I would be looking at that as a residential space too. Hey, yeah, I know I'm probably going to drop rent down a little bit to keep it in track. If you've ever heard about the billionaire investor Carl Icahn, he told CNBC at the beginning of March here, when everything was just starting, when we had this huge commercial mortgage meltdown of over $50 billion gone in a couple of weeks, he knew it was going to blow up, and it got worse. Okay. You're going to have this blow up too. Nobody's even looking at that. All right. Talking about the housing collapse of 2008, how this is going to be very similar. He's been shorting his position on credit default swaps, which you all know that's the big short aspect of things. It happened all over again to loans made in 2012 to shopping malls and malls, which are some of the biggest ones being hit. You have a bunch of mortgages, so the banks went out and loaned money against a lot of shopping malls, office buildings, hotels, and retail. It's all credible institutions doing it again. The banks sold mortgages on commercial real estate, and when they did those mortgages, slice and dice them, put them into something called a index fund. The banks then sold bonds against this mortgage. It's literally happening all over again. Not just retail. You're getting. I honestly believe. I hate to say this, but I think shopping malls are going to be a thing of the past. With everything going online, we know retail's been hurting. Obviously, online sales are up over 30%. Okay, it's got a long way to go down. He said, and that was in March, and he knows it's going down. He's been socking money away to be able to gobble up some stuff, and that's where I wanted to bring this to. This is an article talking about the guy who has, he's got basically a variety of shopping centers across the country, including Illinois. And this guy, where's it? Yes, Sanford Siegel. He told the New York Times he's expecting maybe to get 75%. Because I've seen more, but he also said, I've seen more deals in the past week that were worth looking at than I did the entire 2019 year. So that's what I'm trying to get at. Stuff is already coming across desks. Yes, there's a lot of big guys that are going to gobble up the big stuff, but there's a lot of small crumbs, smaller price points that are going to be available to investors like you and me on a regular basis, okay? A lot of them, and I want to bring this up here, by comparison, property sales, a commercial estate search that tracks deals of $2.5 million and up. They don't want to deal. These big guys don't want to deal with $2.5 million or less. It's too small for them, but that's a big deal for most people. And if you can get creative in working with the tenants who are in place or bringing in some new tenants or helping, if you're buying it cheap enough, which I think you will be when we talk about some things there, it'll give you a lot of flexibility to look at some things. And this is the scary thing. As of mid-May, loan servicers representing 70% of the commercial mortgage-backed security market at 19.3% of hotel loans, 1 in 5, and 1 in 10, and retail loans were more than 30 days late. The end of grace periods could simply increase these percentages. We know that number is going to skyrocket, already knowing that is taking place. So let's talk about where the opportunities. I don't think it's foreclosures and REOs for you. If you want to sit around and wait for your single family, your duplexes, your triplexes in the foreclosure market, it's going to be 2022 before you get things rocking and rolling. And then you're going to have everybody scrambling for it. Is it going to make sense to buy fix and flips? No, because the inventory for REOs is low, specifically in Chicago. I mean, yes, you're going to have more, but right now they don't have a lot. Rentals? I don't think I want to be in the landlord market right now, especially with COVID. I think I'd want to wait 6 months till we get through it before I started taking on any new tenants. Okay, I don't want to deal with toilets, trash outs. Okay, not fun. Here's where the real opportunity lies. And it goes back to what Con was saying there. It goes back to what others have been saying. When you start seeing big guys like that they've been clearing up their portfolios for a couple of years, expecting this to happen, to have cash available so they can spring. Here's the real opportunity. The real opportunity is buying the debt. Now, residential notes, we'll probably start seeing some of this stuff. Well, we're already starting to see some of the residential non-performing notes starting to trickle in. We'll see a lot of it by the fourth quarter. Why the fourth quarter? Because that's when banks are going to start making decisions to either let's get stuff off of books before it gets really bad. We don't want to roll into this stuff into the new year. Let's get rid of it. The election, I think the government will figure out who they're going to bail out or what they're going to bail out. They'll get their head out their asses. Okay? The commercial notes already starting to hit this quarter. They're already starting to hit this quarter. Things are out there. Things are starting to percolate. I'm already getting phone calls from asset managers, emails. Hey, what are you buying? What are you looking for? Do you know somebody might be interested in these type of deals? And a lot of people are like, oh my gosh. But you're going to have to get a little creative. And I love what this guy did in Illinois. This group here on One Arlington Place, he took it from being a hotel into an apartment complex. He turned it into an apartment complex. And you go out and type in One Arlington, and you'll see it pop up on Yelp of what they did to the property to turn it into a lot of 2 bedrooms, 1 bedroom, 2 bedroom apartments. And it's a genius idea. You've got all the infrastructure there. You got to tweak a few things up. But I've got a student of ours, Garrison Gilbert out of Maryland, is doing the same thing there, turning a 55-room hotel into 42-bedroom apartments. He's doing it himself, too. That's a big play because hotels are being hit hard out there. I've got a buddy down the street here that we usually host some of our events at. He's been building another hotel, and I'm like, oh, that's got to be hurting. All right, so you're gonna have to get a little creative, taking some of the bigger box stores, maybe turn them into self-storage units, co-working space, or you can have smaller companies working together. We know that a lot of them are getting out of the big office spaces to shrink it down as they turn their work staff over to remotely working through Zoom or working from home or wherever. Okay. Now, there are a lot of banks in trouble. Are there banks that you should be targeting right now? Well, yeah. Hell yeah. Let me rephrase that. Hell yeah. Okay. Now, one of the things that we pull up on a regular basis is that there is a report that we pull roughly once a quarter. It's a company called Bauer Financial, and they will they'll look and rank banks and credit unions. I only target the banks because that's the debt stuff that we're looking at for the most part. And then numbers came out, and if you look at the numbers, and what I did, we all know banks are lending in multiple states. So what I did with the list is I filtered it down by who's located, their main corporate office, their main office is in what state. All right. And out of the list of about 1,500 banks, 129 of them are actually based in Illinois. There's more than that lend in Illinois. Okay. But for those that are based in Illinois, there's 129 of them. And currently 2.6 billion, once again, 2.6 billion in accrual loans are already 90 days plus. That means on average, there's roughly about a $20 million average per bank. All right. And stuff that's already past due. Basically, it comes out to about 7.7% average of each bank's net worth in loans that are past due. That number's creeping up, a little higher than the national average. And there's BMO Harris Bank was one of the biggest ones, $191 million in defaults. Okay. And then you have Northern Trust is 87 million defaults. All right. Now, that are just in the residential side of things, not their total commercial stuff. That's just what they've got in defaults that they reported on their quarterly report that came out. Now, that makes me think that there's a lot of opportunity. Now, is all of that in Illinois, Chicago? No. But there are a lot of banks that do business in Illinois. Yeah, there's more than 129. The reason I bring that up is I want you to know how big the opportunity is out there. Now, it's opportunity, yes, for you guys. It's also an opportunity for you to help the banks. But it's also, I think, a true opportunity to help America out. I could sit here and talk about being patriotic and wanting to help your fellow American out. And that's something that you should be doing anyway. There's a lot of people hurting out there, and it's nobody's fault. Bad things happen to good people all the time, and we're experiencing that right now. It's not anybody's fault that property values are dropping. And when you have 130,000 properties that are going to foreclosure they're expecting, it's going to dramatically reduce the price and the value of the neighborhoods around them. And I have to thank Tom for sending some of that information, because we're going to see that. We're going to see that tidal wave of values drop. And if you have less than 20% value of equity, and I've been saying this year round when I've been spoken last week, if you got less than 20% equity in your house and the market drops a little bit and you're underwater now, that's not a good time. Now's the time to learn what you can and where the opportunities are to offset that. And the beautiful thing is you've got a little bit of time. You've got a little bit of time to get your ducks in a row to figure out what the heck you're going to do. And what should you be doing if you're really, truly an active real estate investor? You should be looking at buying the debt. Because with these extreme numbers, you can buy the debt now versus waiting around for the foreclosure. And in a lot of cases, get that debt reperforming, buy it cheap enough. There's a lot of exit strategies, and work with the homeowners, keep them in the property. And depending on the location, obviously, I would probably stay outside of Cook County. You couldn't pay me to buy in Cook County again. But there's a lot of other opportunities around, not just in Chicago, but also outside in Illinois, but outside of other states, Indiana, Ohio, Michigan, Missouri are a lot of great states as well, too. That you don't have to be the guy that goes out and guards it at night. You can buy debt on property areas, and there's servicers and vendors that'll help you out with that. And you can control the debt. You take the debt down, you can still leave the owner in place by working with them, especially if you're buying the debt at 30 to 70% off. Man, oh man, that's a big discount. And we're going to see those again, okay? There are hotel hedge funds selling $260 million mortgages on their hotels for less than 20 cents on the dollar right now. They want to be rid of it. And you've got a variety of exit strategies. You can get a reinstatement, modification, short sales, offer a short payoff, foreclose, sell the loan to somebody else, offer up cash for keys, deed in lieu. A lot of strategies make some money. Take over the note and turn it into cash flowing, and then get it as a reperforming note and keep it for cash flow or sell it in the open market, or take over the property and do what you want with it to take the property back. Okay. Other advantages of note investing, I know these are some big advantages I think that get overlooked a lot, is we're not wasting money on direct mail. And I know as a real estate investor for almost 20 years, a lot of people are really tight on budget-wise. They don't have the money to send out yellow letters. They don't have the money to send out postcards. They don't want to go driving in some neighborhoods and door knocking. They can't put up bandit signs because they don't know what's going to happen. And I know people are spending $3,000, $5,000, $10,000 a month to really try to up each other because there was a limited pool of REOs and foreclosures back then, still before this started. It's going to be a while. So sit around and do nothing or actually take action. Well, you don't need direct mail. If you've got an email and LinkedIn account, free LinkedIn account, and you don't mind getting the phone and dollar for dollars with email and reaching out to asset managers at banks, you can find deals. You can do notes. All right. And the beautiful thing that I love about note investing is one source. Like one of those banks had 588 branches. If I tackle into one of those branches or the bank and I get their list every quarter, every month, do you think I'm going to have some deal flow for the next 12, 24, 36 months? The answer to that is a hell yeah. All right. Okay. You don't have to buy them all. You can cherry pick the best deals for your portfolio. Now, the residential side, we're going to see a lot. Commercial side, we're going to see a lot. Okay. If you want to buy in bulk, hey, you're going to get better pricing as well too. If you've got some investors, you've got some friends, families, and there are investors out there. There's a lot of people with money sitting on the sidelines. And it doesn't matter if you want to do residential, commercial deals, you can do a lot of the same things, but I would tap into the commercial wave right now because you're gonna be able to pick up some deals relatively inexpensive, okay? And if you don't have the money yourself, hey, don't worry about it. Raise capital from other investors to fund the deals. There's a lot of great things going on. And if you think about this, guys and gals, in 2010, there was 15 million homeowners underwater. That was the peak of the Great Recession. 15 million homeowners underwater in 2010, 2 years afterwards. Well, we're 3 times faster to 1.6 million defaults. Do you guys think there's going to be 45 million homeowners underwater? I sure as hell hope not. But we're going to see some numbers that may get close or exceed that. Now, the question is, how many people do you want to help? How many deals do you want to buy where it not only benefits you, but you can help the homeowner borrower out? Helping the homeowner out of the situation where they maybe just move on. They take that away from them. They move on and can get on with their life. It's a great deal for you. You do a variety of things with it. Are there investors out there? Yes. Heck yeah, there's a lot of investors out there. Let me give you some of the numbers. Some of the staggering numbers in Chicago. This is just Chicago alone, not across the entire state. We all know there's $9 trillion in funds and retirement funds across the country. That's a given. But in Chicago, there are at least 104,000 investors who have an IRA account, a self-directed IRA of some sort. Okay, 104,000. I know I can tap into stuff, so trust me, that number's right. Out of that 104,000, 69,000 of them have at least 150 or more in their accounts. What? Yes, almost 70,000 people have at least 150,000 or more in their accounts. How many investors do you need to talk to be able to raise some capital to take down a deal? If you know the deal, know the numbers, and can buy something cheap enough, which we all have the capability of doing, there's some opportunity there for you. And let alone, there are 71,000 real estate investors in Chicago alone that they classify themselves on their taxes as real estate investors. That's a crazy number. Doing a variety of things. Some of you guys are on here tonight. There's a lot of opportunity out there if you get a list in to market to other people. Maybe something you don't take down. Maybe you're wholesaling the deal. Maybe you're flipping it for a fee. Okay? There's a lot of ways to make money in the debt business. And the question is, do you want to be the bank or the borrower? None of us want to be the borrowers. Nobody wants to be in trouble. Some of us are in trouble. Okay? I've been there before. I've been a distressed borrower before. Not a fun place to be. And some of you guys that are watching this may be on that. Well, you have 2 options. You can either sit there, cuddle up in a ball and rock yourself to sleep, or you can get up and go to work and do something about it. If you've got some forbearance time frame, if you've got 6 months, you've got 90 days, now's the time to start honing those skills and putting things in place. Okay? So the biggest thing is you want to be the banker because the bank always wins. The bank's going to get paid some way or another, and it's good to be the bank. All right. So how do you tap into the tsunami of deal flow? Well, I've been teaching real estate investors about notes since 2000 and well over 10 years. Thousands of real estate investors purchase their deals, their first notes, gone on to buy hundreds of deals. I'm so proud of my students that closed on thousands and thousands of deals out there. And it's been residential or commercial. I got started doing commercial notes in 2008. That's why I'm so excited about what's going on right now. All right. So excited about what's going on right now because I think this is an opportunity of a lifetime for many of you. It's an opportunity of a generation. It's actually a two generation. It's the existing generation that's struggling and your future generation of you being able to help you, to be able to do some amazing things. I don't care where you're at, what you've gone through, if it's been through the divorce, you've been through a foreclosure or a short sale, you're in trouble right now, you hold the keys to you taking advantage of the opportunity to do something. And if you want to grow cash flow, which is always the smartest thing to do first, or asset growth, you want to add some stuff to your portfolio, great. If you don't have a portfolio, start one. Now's the time to do it. You can buy one-offs. Yes, you can buy one-offs. You can in bulk as well, too. But don't let somebody out there tell you, oh, I tried that note business like 10 years ago, and I couldn't get it done. Well, that's because you're probably taught wrong. Most people, when they get into the note business, they approach the debt side of things. They start thinking like a real estate investor or a fix and flipper or a wholesaler. No, you have to think like a bank. It's a different mentality, okay? But we have made trades happen from 25, well, less than 25 grand, but all the way up to 5 million and beyond. So you don't need to have a lot of capital. There's a lot, especially in Illinois, there's a lot of investors at local investment clubs. Heck, you could even identify them in your own neighborhood. Okay? And I don't care what your credit is. Bank's not going to look at your FICO, your FACO. They're not going to care where the funds come from. They don't need to season them. They're not asking for earnest money unless you're buying a big portfolio. It's a huge opportunity for those that are struggling. How do I know this? Because 10 years ago when I was struggling, 12 years ago when I was struggling, not 10 years, but 12 years ago when I was struggling, I didn't have any money. It was a bad time here in Austin, Texas at that point. I got my last two properties. I had to write checks and was basically bankrupt for the most part. I didn't have money for earnest money. I didn't have money for a big down payment, but I made notes happen by getting the list sent to me, looking at it, doing some due diligence, marketing it out, basically using my wit. And today it's a whole lot easier with marketing to make things happen than what it was 12 years ago. Like I said, if you've got email, you got a LinkedIn profile, which can be free, and you're not afraid to jump on the phone or send an email out here and there, you can make this happen in today's market. So whatever your focus is, whatever your itch, whether it is single family homes, mobile homes, duplexes, triplexes, fourplexes, apartments, student housing. Student housing is about to be really cheap in a lot of places, okay? Hotels, okay? Retail office space, self-storage facilities, medical office, mobile home parks. There are deals across the board in all asset classes, everybody. It's up to you to figure out what you want to do with them and how you want to attack those things. And you know what? The beautiful thing is if you like one specific asset class, great. There's lenders that do specific things that you can create true win-win stories and actually a third win. Not just a win for you and your investors, but a win for the borrowers who are in trouble. They get out of a bad situation, or you work with them to keep them in their house, and it becomes just an amazing thing. Kind of like this story in South Beloit, Illinois. This couple had been trying to do a loan mod for 4 years when I bought this note a few years back. Great, they'd lived in the house for 18 years, raised their 3 kids. He had gotten sick, I think, with a heart attack, was out of work. They were trying to survive, and their loan had been sold 4 times. And every time the loan had been sold, Sheila had taken the time to fill out all the paperwork to send in a new loan mod package, faxing their financials, faxing the WDs. Can you imagine how stressful a situation that is? When you fax everything in, even FedEx it into the bank, and then suddenly 6 months later, you got to do the same thing all over again with no response. And when this note came across my table, it was a part of a bulk order that I bought. And I was looking through the collateral files electronically, and I saw these all. I was like, oh, this lady really wants to stay in her house. And what I could buy the note for was 33% of as-is value, about 20 cents on the dollar of what was owed, because they were upside down. They hadn't taken the loan. They'd taken a new loan out, pulled some cash out to update the property and help with expenses, not go joyriding. And when I saw that and was looking at everything, I said, yeah, I'll buy this. Now, this lady looks like she's interested in staying. And once we closed the note, I picked the phone, called her, and told her her loan had just been sold again. And she started crying on the phone. I was like, listen, don't worry about it. We're going to come to a conclusion right now. You want to stay in the house? Can you start making your existing mortgage payment? I think it was like $450 a month. She's like, yes. Look, I know you can't bring the 4 years to the table that you're behind on because you've been trying to do this for 4 years. What can you bring? Can you bring like $5,000 to the table? She's like, no, I can bring 2,500. I'm like, okay, great. Awesome. Bring 2,500 to the table. Could you pay an extra, say, $200 a month the first year on top of your 400 or 450? She's like, yeah, I could do that. Great, let's do that. And tell you what, at the end of 12 months, I'll drop your interest rate down to 0% from the 8% it was at, so that every dollar will make it retroactive to when you actually signed on the trial payment plan. Everything beyond that first 2,500 will go towards principal. And after that year, basically you have a 0% interest. Every dollar you spend and pay will go towards the principal of your mortgage, and you'll have the mortgage paid off in less than 7 years. Her and her husband cried at the closing table, understand. And they probably cried a little bit more because a couple months ago, I got a request for a payoff. They only had a couple payments left and paid the house off in less than the 7 years. And I can't imagine the joy that family feels and the stress, the relief lifted off their shoulders. Don't you want to have that kind of effect on people? I know I do. I love that aspect of things. I love helping people. I don't like to be the guy and evict and foreclose. That's not what I got into the business for. I got in to help people if I can. Now, yes, do we have to foreclose? Do we have to evict? Do we have to send the attorneys or bulldogs after people? Yeah, I run a business. I don't run a charity. But the beautiful thing is I don't have to do that. I don't need to know the foreclosure laws. I don't need to be the person out there and do it. There are vendors and servicers that are part of the deal that help this. So you don't have to be the expert in all those fields. You don't have to have a mortgage or finance background. We've got people from all backgrounds and all experience and doing amazing things out there. And you can do it big or you can do it small. Our buddy Gene here from Elkhart, Indiana. When we met him a couple of years ago, he was buying an occasional property in Elkhart here and there and trying to work it out, do all the work himself. He'd been through a bad financial situation a few years prior. And I got an email, a text message actually from him from about 2 weeks ago, 3 weeks ago maybe it was. He was just saying, man, Scott, I just want to say thank you. He goes, I now have a fund in place with over 13 million out in the market invested with me. I'm closed on like asset number 150. And it's just a whole different lifestyle. He's no longer a hot shot operator. He's doing this full time and doing whatever else he wants on his other spare time. Not working 40 hours a week because he's got his systems in place, but doing amazing things. Laura Blunt just bought and moved into her house, her dream house that she's wanting to live in Maryland. And she was an investor here in Austin, Texas, doing like many real estate investors do, doing a little wholesale and a little bit of light rehab, just trying to make a hustle. You know, like many investors do. They go from class to class to class to solution to solution. We got all these tools in the tool belt, but we don't know how to fix the problem. Well, she learned the note business from me, bought a couple assets, their own funds. We showed her how to raise some capital, and she went out and has bought close to 100 assets in the last year. And she's working on a large portfolio, I think about 130, 140 assets, a $4 million purchase right now. And I'm so overjoyed at the success that she's had. She's changed her trajectory for not only for herself, but her two boys as well, doing amazing things, not only doing good for herself, but for the people that she's keeping in the houses as well. We have our buddy Keith Collins out of Mason, Ohio, I believe. And Keith sent me an email, well, not too long, about a month and a half ago, saying, man, Scott, thank you so much for what you've taught me. In the last 12 months, he and his wife, Lisa, are going to make over 7 figures in the note business. Buying debt, keeping people in houses they can't. If not, they work to take the property back. And that's great. And yeah, you don't have to be a little bit more seasoned. You can be young. We were pretty excited about what these 3 people have done. We've got tons and tons and tons of cases and testimonials. But I get really excited about somebody who's getting started in life, trying to figure things out. And that's how I feel about Rafael out of San Diego. One of my most recent students, doing an amazing job out there. He's an entrepreneur like many people, had a car detailing business in San Diego. All right, doing well. 15 full-timers working for him. And you know what happened with the corona? Closed, done. If people aren't driving and they're sitting at home and looking for something to do, they're not going to pay somebody to come detail their car. They're going to do it themselves. And that's what happened. His business shut down. But he was smart enough Know that he didn't want to do that. Back in December, he started learning the note business, learning the deals, and he bought 5 deals in his first month and a half, 2 months of being a student of ours. And he's selling an asset right now. He just texted me about an hour ago. Hey, how do I do this? Do that. But he's got 2 of the assets reperforming at like a 12 to 15, if not higher percentage ROI. And the other 2 out of the 3, he's selling and making money way above what he paid for the notes. And we get so excited about that. Right? He says, man, I wish my employees would take as much interest, but I've got to do what I got to do. And we all got to do what we got to do, right, everybody? So like I said, if you want to do this big, great. If you want to do this small where it's a hobby or it's like hey, I'm pretty set off where I need, but I need something to do to stay busy, that I don't have to go out and worry about getting sick or worry about traveling. I can do this from the comfort of my own home. Then buying debt in the note business is probably what you need to be looking at. And we've helped hundreds and hundreds and hundreds of investors across the country not only make a difference in their lives, but make a difference across the country as well. And how did they do that? They learned from me. They came and were taught by me. Now, most of them took a 3-day workshop that we offer called Note Buying for Dummies. We'll offer that about 3 times a year. But many of you probably are like sitting out there, well, I don't know. Well, that's okay if you don't know. That's why we offer up a very special 1-day training called Note Weekend. It's a kind of a Cliff Notes version. You dip your toe in the water to feel if water's warm for you to jump in, if you feel like you can do this. We like to simplify things down is what I like to do. I don't like to teach over your head and tell you can't do things. Look, I'm not the smartest guy in the room, but I know I'm the hardest. If I have the right tools and it will work, I can make things happen. And I know that most Americans feel that way. Give me the tools. Don't sit here and blow smoke up my ass. Don't try to give me a pitch fest. That's not what I do. My 1-day class called Note Weekend, we have those about once a month. And it covers basically, like I said, the Cliff Notes version. Our students have taken the class again, like, oh, this is a great, refreshing course. It's awesome because the market's always changing. It's not the same thing it was 2 years ago. We're constantly changing this class. And like I said, it's a 1-day from 9 a.m. to roughly 3, 4, 5 o'clock in the afternoon. Just me teaching, all right? It's a mini workshop. We live stream it via Zoom on a Saturday, so you don't have to worry about jumping on a plane, right in a hotel, facing death. You do this from the comfort of your own home. Can't make it all day Saturday? That's okay. The Sundays are available. On Sunday, the replays are available. We live stream them and send you the link so that you can watch them, download them to your iPad, whatever you want to do. Like we said, it's called the Cliff Notes of Note Investing, and it's just $49. Normally it's $99. We're cutting it in half because of Corona. But like I said, 9 a.m. to 3, 9 a.m. to 4. It varies a little bit depending on how many people have in class. I'll stick around as long as possible. And we take a couple breaks, but literally if you go to noteweekend.com, you can see the schedule. You can actually click there and get signed up for it. All right, straight from there. The next one is July 25th, so it's just a couple weeks. So 2 weekends from now, it's a Saturday. The next one after that is going to be August. After that, we'll probably have one in September, October, November, just varies on, because it'll probably be in September, we'll probably have in our next 3-day workshop. And the thing that we love to do is 2 things. One, if you sign up for it, $49, great. You'll not only get a manual, you'll get the replays to it. But if you, at the first break, you're like, Scott, I just don't think this is for me. Hey, don't worry about it. I'll refund back your $49 and wish you well. Now, if you do go through the whole class with me and you're like, hey, I like this, where do I go next? I'll even apply that $49 towards our workshop or other trainings that we have. And another bonus that we're doing as well with the Note Weekend is that if you get signed up for it, you'll also get a ticket to watch me call banks for a good 6-7 hours. We did this 2 months ago, and we had about 80 people on the call who watched me call banks one afternoon for 4 hours. They heard the conversations. They heard the discussions. And I'm looking forward to doing this again sometime soon. So yes, if you sign up for Note Weekend, you'll get a ticket to that, the 1-day bank call, and that's usually $49 by itself. The replays, the manual, the links to other videos and vendors. We do a lot of great things out there. So besides talking about where to find these notes, we'll also talk about the ways to fund these deals and some of the things you can do very easily to structure deals. We'll also talk about the different exit strategies. How do you make money in commercial and residential notes? How do you make money with each strategy? We'll also discuss the different vendors and team members that you need, and I'll make the introductions to them for you. Great if you use them, great. If not, hey, no biggie. We'll also talk about some different loan trading platforms, commercial and residential, that you can start looking at deals today. All right, start evaluating deals, start honing your craft. Look, it's great to know a class. You're not going to learn the note business in 1 day. You're not going to learn everything about note business in a 3-day workshop, but you will learn more about note investing by actually taking action and starting to make offers and work through the due diligence. And we have such a resource of information for you out there. If you got so much stuff that we cover and make available, we've got the podcast, the Note Closer Show. We've got our YouTube channel, WeCloseNotes.tv, with over 1,000 videos on there, podcast, educational stuff for you to tap into. I believe in giving you the tools to go out and make you successful. I'm not going to sit here and bullshit you. I don't do that. If you want to take the action and put it to work, we'll walk you through how to make things all just for $49 on this thing. Now, what do I get out of this? Hey, if I get 60, 70 people sitting at home on a weekend, on a Saturday with me, that leads to a couple of things. Not only does it help me educate an army of note investors, but when I get deals in, it also gives me a distribution network to send them to for those that want to get started. And we've taught a lot of people. And my big goal is here before the end of the year is help 10,000 note investors or investors learn how to be a note investor. All right. So once again, guys and gals, if you're interested, 1-day class, live stream on Saturday, restream on Sunday, replays will either be Sunday or Monday. Get the Cliff Notes of Note Investing, $49. You can go to noteweekend.com. If you can't make July, you can make it the August 29th class. And I'd love to have you be a part of that. So I want to open it up for questions right now, or comments for you guys that are watching this and who might be interested in taking it to the next level. Or if you have any questions about the market, any questions about anything, I want to open it up to that for you guys as well. One of the great things that we do at the end of the Note Weekend also is like the last hour, we actually open up and have a virtual networking event. I know we all miss on going to events and networking with new people and building relationships like that where you can reach out and shake hands or have an adult beverage. Well, you can't do that. You can't shake hands. You can still have the adult beverage on the computer if you want, but we try to make that where you get know a little bit about you. What are you focused on? Where are you looking at? And how can we help you take your business to the next level? So any questions, comments, or concerns? We're right at, just look at that, 53 minutes. I try to stay on track for you guys. Once again, if you go to noteweekend.com, you guys can get signed up for the next one, July 25th. If you can't make that one, let me know. We'll be glad to bump you into the August 29th class as well. So if there's not any questions or comments, let me look online. I may have a couple, looks like it's a couple notifications here from online. We also have our group, our private Facebook group for our students called Note Nation. That's a great resource with roughly just under 900 investors, 900 students of ours. It's a great place for people to network and learn information as well too for you guys. Hey, Leah. Hey, Julianne. See some people online there. Julianne says, my estimate is that on top of foreclosure, you will see a saturation of import of people moving out of Illinois. Yes, you will probably see a big transfer of people moving out of Illinois, at least moving out of Chicago. Already starting to see that where overnight, I did not include this slide in there, but overnight there's been a huge reduction in prices. Listings have been canceled, 30 to 50% reduction in listings. And yes, you're seeing that not only in Illinois and Chicago, but you're seeing that across the country where people are moving out of the urban areas, moving out someplace. If they can work remote, hey, if I can, we've seen that happen in Austin here forever. If I can move out and be in a less occupied area where I've only got to go to the grocery store once a week, I don't have to come in contact with people for quite a bit. That's going to be a big thing. So yeah, Julianne, thank you for sharing it. I agree totally with it. There's talk about that who's moving into the urban areas more so than anything is be the younger people, but they're going to have to do with less businesses, less restaurants. It's unfortunate. Fast food is going to lead to a lot of sickness too, because that's really what's open for the most part is fast food. And we all know fast food is no good food. So thank you for sharing that. Great point. Great stuff there for you. So, all right, everybody. Well, if that is it, I will let you guys get on your merry way. Have a great evening. Be safe out there. If you have any questions, comments, concerns, feel free to reach out to me. You always schedule a quick phone call with me by going to talkwithscottcarson.com. That'll take you straight to my calendar. You can book a 30-minute phone call with me. And we discuss where you're at, what you want to do, and see if notes is actually something that you'd be interested in. But otherwise, be safe out there, everybody, and have a great evening.